Hey everyone, it's Greg Phelps, your host to the Retire Wire blog and podcast, as well as the president of Red Rock Wealth Management here in beautiful and sunny Las Vegas, Nevada. I'd like to thank you for stopping by the webinar today because I'm going to teach you 3 ways that you can add about $250,000, and I'll go through all the math, to your retirement risk-free. That means you're not going to take any additional risk. These are 3 tactics, and they're not my tactics. I'll explain to you whose tactics they are. You'll be impressed. Anyways, so we're going to get started in just a few seconds as a few more people filter into the webinar now. Grab a cup of coffee or a soda and a notepad and a paper because you're definitely going to want to take some notes. So just sit back, relax, just a few more seconds, and we'll be getting started. Hey, okay, so let's go ahead and get going. I think we've probably got everybody into the webinar who wants to be on this webinar by now. So again, as I mentioned, my goal in this webinar, and I'm going to ask you at the end, did I accomplish it? But my goal in this webinar is I want to teach you how you can add $250,000 to your retirement without taking any additional risk at all. And if I can accomplish that, I win, I'm thrilled, and you can take these strategies and implement them. You can take them and use them with your financial advisor, have them watch the video. That would be great. So I just wanted to make sure that is the goal. Now, the other thing that I wanted to mention is that if you stay to the end, I'm going to share with you in an email all of the reports that I reference. You're also going to get some very, very handy cheat sheets and some bonus guides. So some of the stuff that you're going to need to implement these things, you're going to get immediately if you stay through the end. And even better is you're going to get an additional 6 strategies. I'm going to blow through them at the end. You're going to get the reports. It's going to be fantastic. But these 3 are very, very critical. These are the most important 3. So what I found when I do webinars is that a lot of times the emails run in the background, or I got Facebook on my phone and, swiping up and down and so forth. And I just got to say that this information is incredibly important. It will help you. I promise that. I will deliver for you. But it makes sense if you just kind of turn down, mute the distractions. And so just a little bit of housekeeping there. And one of the most important things about what I'm going to discuss is you're going to learn, I've been doing this for almost 30 years. You're going to learn from all of my experiences, my successes, my failures, and additionally, the thousands of clients that I've worked with over the last few decades. You're going to learn from their experiences as well. I'm going to roll that all into this webinar, into these 3 tactics. So you're going to get a whole lot of knowledge. And finally, the last thing before I really dig in is, what would an extra $250,000 mean to you? I mean, would you be playing golf at the private courses and not the muni courses? Would you be driving the Lexus and not the Honda? Or maybe you and your partner would be taking the trip to Europe and not necessarily just a state across for vacation. Maybe it's spending more time with the kids or leaving a legacy for the grandkids. So there's a lot of things that you can do with an extra $250,000, and I'm sure I'm preaching to the choir, you know that, and it's a lot of money. And so let's go ahead and get started on why me? Why are you listening to me right now? Who am I? Well, my name is Greg Phelps, as I mentioned. I have a very big passion for the educational concepts that we use with our clients every day. And that's why I'm here talking to you and so forth. My biggest passion is, and where we add the most value, is helping retirees retire with confidence, plain and simple. By squeezing every last dime out of your finances, we can help you retire with more money and more confidence. And it doesn't necessarily mean taking more risk. That's the beauty of it. And I would also kind of impress upon you, you think at this point you're doing everything right. Chances are you're not. You think your financial advisor is doing everything right. Chances are really high that they're not. You think you're squeezing every last dime out of your retirement. Chances are it's just not happening. And my point is, you can do it. I'm going to give you the 3 tactics. I'm going to give you the 3 strategies. And it's very important that you go ahead and follow these things to some form, at least, because every little incremental change you make in your retirement is extra life to you and extra gifts to your family when you're gone and extra trips now. So it's very important stuff. Now, how did I come about being here today? Well, my career goes back to 1995 when I was actually training in the World Trade Center, which is no longer there, obviously. with one of the big brokerage firms, Morgan Stanley. And additionally, after that, I could say I was kind of disgruntled with the brokerage industry because they're more focused on shareholder profits than client profits. And producing those products and selling those products that are proprietary, high commission stuff that maybe is not right for you, but it's really good for their shareholders. So I became disgruntled and I went to a bigger firm, in my mind at that point, a better firm, Goldman Sachs. So I spent a little bit of time on Wall Street. I've seen it from the inside out. I can share a lot of positives and a lot more negatives, unfortunately. I even worked for the fourth largest accounting firm in the country, RSM McGladrey, for a period of time, and it really wasn't much different. Didn't matter where I went. It was the same story. Shareholder profits come first. Shareholder profits come first, not your profits. And that's why I finally became fed up. And in 2005, I founded Red Rock Wealth Management as a fee-only fiduciary financial advisor firm. That's right. We were fee-only. We were fiduciary before it was cool and trendy. Way back in 2005, we were the only one in town. And so that's a little bit about my background and my history. I don't really care to get into the alphabet soup game. I say alphabet soup because my kids, if you look at all the letters and credentials after my name, my kids sometimes rearrange them and poke fun at me, or they give me some good new words with those letters that they can rearrange, just like alphabet soup. If you really want to dig into more of my bio, it's on retirewire.com. It's on redrockwealth.com. You'll find anything you want to know about me. Suffice to say, I've been doing this a long time, since 95. In fact, a little bit of trivia. I was actually 20 years old in 95, and as my training class was going out after training, to the bars, and I couldn't even enjoy that with them. That's how long I've been doing this. So without further ado, I want to go ahead and dig right into the numbers because it's very important that you understand the strategies that I'm going to talk about today. They're not mine. Now, granted, we've used them. We've used them for years. It's nothing revolutionary to us, but I'm going to give you this added level of verification on what I'm going to talk about. These strategies are actually from Morningstar and Vanguard. So if you know anything about investments in the industry, Morningstar and Vanguard, they're behemoths, they're huge, they're highly reputable. There's really nothing you can say negative about them that I can come up with or that I've heard anyways. So these are not necessarily my strategies. These are strategies from Morningstar and Vanguard. And where they come from is two reports that, again, I'm going to send you at the end. Two reports that they've done over the last several years. One of them, Morningstar, has 5 ways that you can add up to 3% per year to your retirement planning. So you'll notice I'm not going to talk about 3%. But Morningstar's, they kind of lump these strategies in a little bit differently than Vanguard. And so Vanguard has 7 strategies. So I read these reports over the years, and I've done other webinars on them. And what I came to realize is that 3 of these tactics, they agree on wholeheartedly. Now, they don't say it exactly the same way. They don't have the exact same math behind it, but the general concept of the tactics, Morningstar and Vanguard say these 3 tactics we agree on, basically. And so that's why I'm focusing this webinar on those 3 tactics. But again, stick around to the end. I'm going to give you the other 6 because they agree on these 3. So 6 and 6, 12. Morningstar has 7. Vanguard has 5. You can do the math on that. But how do I come up with $250,000? Because that's a huge number. Well, it's actually not $250,000. I'm embellishing a little bit. It's actually $249,393. So yes, I embellished a few $100s there. So how do I come up with that math? And how can you add that to your retirement? Well, it's real simple. If you look at a study by Business Insider, they say that the average retired couple, and I'll send you this report as well at the end, the average retired couple has amassed a fortune of about $642,000 when they hit that retirement stage. So early 60s or so. So they've got $642,000. So that's not your number. You're more or less somewhere, it'd be odd if you were right exactly there, but that's not your number per se. So they have $642,000. What do they do with it? They're going to go spend it. They're going to live their retirement dreams and so forth. But they're also going to put that money to work. And the normally accepted retirement withdrawal rate is about 4% a year. It's beyond the scope of this webinar, but that goes back to another study that effectively says, going back decades and decades, what is the rate of withdrawal that you could pull from your portfolio without ever running out of money in the worst possible time? That's the best way to look at it. And that number ended up being about 4%. Now, the older you are, that number can go up. There's a lot of variables, but that number's about 4%. So what I did was I said, Vanguard, they took these 3 tactics and they said, how much value do these 3 tactics add? And in Vanguard's assessment, if you're the optimal person to take advantage of these three tactics, you can add 2.2% per year to your retirement planning. We take Vanguard's 2.2% and you can add that onto your 4% withdrawal rate, and then you get this number of 6.2%. But what I did is I took Vanguard's 2.2% and I cut it in half. Because what if you're not optimal? Let's get a number that's more realistic for you and everybody else on this webinar. And so we cut that in half and we say, what if that 4% that you're earning, that safe withdrawal rate that we discussed, quote unquote safe, and we added 1.1%. Well, that additional 1.1% is where we come up with that $249,393. That's where you get that added $250,000. That's how I created this number, is take the high mark, cut it in half so we get a more reasonable expectation of what you can actually gain. Now, your question is probably, well, what if you're optimal? And what if you get that 2.2%? Well, that number ends up being almost $600,000 on that average retiree's portfolio. So as you can see, there's just a huge amount of money, whether you're on the normal rate or the optimal rate, that you can add to your retirement. And so these strategies, they're fantastic. So let's go ahead and let's dig right in to the very first strategy, which is Vanguard says you can add about 0.35%. Oh, and by the way, I'm starting with the smaller value addeds first. And then by the time we get to 2, it's a little bit better. And then by the time we get to the third strategy, it's even better. So stick around. But Vanguard says you can add about 0.35% just by efficiently rebalancing your investment portfolio. So let's dig right into portfolio rebalancing. Here's where the fun begins. Let's go ahead and talk about what is portfolio rebalancing. The very first thing you need to know is that we have a portfolio that you're going to invest in through your IRAs, Roth IRAs, 401ks, taxable accounts, and so forth. And that portfolio is going to consist of, for example, stocks. And stocks are going to be volatile and have a higher expected long-term return. And that portfolio is probably going to have bonds. And bonds are going to be less volatile and have a lower expected return. And finally, it's going to have probably some cash. And cash is going to have a very, very low expected return, but less or no volatility. And you could possibly even include, we're not going to go too deep into this, but alternatives. And alternatives will just do something completely random and have a random return depending on what it is, whether it's something like oil or gas or commodities and so forth. The point is, with these different asset classes, if we take them all and blend them together, stocks, bonds, cash, alts, we're going to get an investment ride that's much more conservative than, for example, stocks, because you can use bonds and alts and cash to dial in the volatility. That's the asset allocation process, determining how much in stocks, how much in bonds, how much in cash, and how much in alternative investments do you want to have. So that's where the whole process of rebalancing starts, is with asset allocation. Now, how much you put in each one of these asset classes is dependent on you, and most importantly, it's dependent on your financial plan. If you don't have a financial plan, and I'm not talking about a watered-down sales pitch that's designed to sell you something. I'm talking about a real financial plan, something that's designed to get you from point A to the end of the game, for whatever that is for you, in the most efficient way possible, not just a watered-down sales pitch. But your financial plan will dictate this based off 3 things. One of them, real quickly, is how much risk tolerance you can take. Another one, that's just a simple questionnaire. We have those on the website, Riskalyze. If you'd like to take one, just reach out. Anyways, this second one will be your risk capacity. How much risk can you take and not have a bad market completely destroy your retirement? And finally, there's your risk required. How much risk do you need to take to accomplish whatever levels of goals that you have? So that's what's going to determine your asset allocation. But for purposes of this, let's talk about a simple asset allocation that just has 2 asset classes. We're going to say that we've got 60% stock, and we've got 40% bond. So real simply, obviously this is going to get incredibly complex if you have large companies, small companies, value companies, international companies, growth companies, and even if you add alternative investments, it gets more and more and more complex. But that being said, the simple way to look at this is if we just had, and to grasp the concept, because you're going to need to use it, is if you just had these 2 asset classes. So what do you do? Well, as you put your asset allocation into practice, Tomorrow you wake up and the market's changed. Bonds went up, stocks went down, and so forth. So rebalancing says we need to make sure the 60-40 asset allocation is what we wanted. That's what's going to get us from point A to the end of the game. And that's the risk and reward profile that is comfortable for us. Now, what happens in a few months is, what if stocks do really well? Now you're a 65% stock allocation. What if they do really well in 2 years? Now you're a 70 or 75%. Who knows? The rebalancing process is actually the best way. It forces you to buy low and sell high. Here's how. What you're going to do is you're going to assign drift targets. And so these drift targets are going to be, let's just say, we're going to let the portfolio drift 10% for simplicity. So this would be 6% on the stock side. So if stocks went up, so now you've got a portfolio that's 66% in stock, you've got a problem. Or conversely, if stocks went down and now you've got 54% in stock, that can become a problem. Not yet though, because you haven't breached the drift target. And so what happens when you breach the drift target? Well, now all of a sudden we're into the red zone. And what we don't want to do is be in the red zone, so we have to do something about it to bring your portfolio back into compliance. So what do? Well, let's just say, for example, stocks went up. So we got our stock that went up, and now we've got this entire portion of the portfolio that's actually equity, and your bonds are now suffering because they didn't do as well. What we have to do is sell some of this and replenish the bond portfolio. It's pretty simple in concept. Again, it gets even more difficult when you talk about high quality bonds, low quality bonds, international bonds, and high yield junk bonds. You could even throw preferred stocks in there. It gets more and more complex the more diverse your portfolio gets, and you need that diversification to balance your risk and return. So this is just a very simple explanation, but when you think about this explanation, it makes a lot of sense. Vanguard puts a 0.35% value added onto portfolio rebalancing. This is something that you need to do. The next question you're probably going to have for me is, okay, great. Well, when do I do this? When do I rebalance my portfolio, Greg? And that's going to be a little bit different for everybody. But I have a little bit of an issue when we talk about, for example, rebalancing a portfolio where we've got stocks and we've got bonds. And let's just say that both of these are indexes and they both start here at 1,000. And this is January. There we go, July, and there we go, December. And what happens is stocks may creep up through July and then drop back down to December. Bonds may drop through July and go back up through December. Well, what most people do for rebalancing is they just look at this once a year. So they're going to say, okay, here we're on target and here we're on target, nothing to do. The problem is you're missing this opportunity here, to basically be selling some stocks as they're higher and buying some bonds as they're lower. And if you were to do this on a more regular basis, it could really benefit you. I'm not talking about trading every day. I'm not talking about trading every month. I'm saying you need to take a look at your portfolio on a monthly basis. That's what we do here, sometimes more frequently. In highly volatile times, we are going to look at your portfolio every week, every 2 weeks possible. In fact, we've been doing that this year. It's been very, very volatile for the first part of this year. So I just think that there's more that can be added by having a more consistent approach, a more frequent approach to looking for these rebalancing opportunities. That being said, rebalancing, even annual, is not bad. It's perfectly fine, and it's something that you should be doing at the very least. Now, you can rebalance too much. You don't want your portfolio to go from 60% stocks to 61, and all of a sudden you got to make a bunch of trades. Every time you have to trade in your portfolio, you're going to have tax implications and possibly trade costs and so forth. So you don't want to rebalance too much. I'm just making the point or the case that you need to look at this on a regular basis and have your drift targets set in place. Those drift targets could be 10% of target, it could be 15 or 20, and those even go deeper. So, for example, small cap value companies. You might have a drift target on those of 15%, and so, but you might only have an allocation of 10% of your portfolio. So then you've got to look at above 11.5 or below 8.5. So those are things to consider. I'm just saying that you can get more advantageous results of buying low, selling high if you're rebalancing or looking at these things more frequently. So let's go ahead and move on to Vanguard's strategy number 2, which is asset location can add up to 0.75% to your retirement planning. Okay, so we already covered Vanguard strategy that adds 0.35%, which is portfolio rebalancing, very low hanging fruit. Now we're going to step it up a little bit. We're going to go to Vanguard strategy of asset location. We already talked about asset allocation. This is not that. Asset allocation is how much of your stocks and bonds do you put in your overall portfolio. Asset location is what accounts do you put those stocks and bonds and different asset classes in? So let's go ahead and dig right in. So in any really well diversified portfolio, you're going to have investments. And those investments are going to be, for example, stocks. And for example, you may have US and you may have international. And in the US, you may have large and you may have small, and they may be value and they may be growth. Same thing international, you might have emerging, you may have international small. There's a lot of different asset classes out there, depending on how precise you want to get and break these things up. So you're also going to have in your asset allocation, you're going to have some bonds. And same deal here. You may have high yield. You may break them up into length of maturity. So you may have short term. You may have long term. The point is they're all going to have different tax ramifications. And you may also have your alternatives. And that may be REITs, for example, real estate investment trust, maybe commodities. And again, the point is they all have different tax implications, and we need to use those tax implications to your advantage. That's that 2.2%, cut it in half, 1.1%. That equals that $250,000 is based off of no additional risk. It's just being smart with your money. So you've got these different asset classes, and additionally, you've also got different types or styles of asset management. So you may use a mutual fund, or you may be trading your own account. That is an active approach, meaning that you or the manager or your financial advisor is ducking and dodging and timing and trading and saying, I want to buy this stock, now I want to sell it, now I want to go to cash. They're trying to outsmart everybody else in the marketplace, which statistically doesn't work. They lose 75% of the time. You can find that on retirewire.com. Or it may be a passive approach. Now, passive is more like your quote-unquote stereotypical index funds, which are going to have a much lower cost, much lower turnover, much lower taxes. So even how your portfolio or your investments are managed plays into this asset location discussion. Now, finally, and the most important part is within this process, you're going to have, for example, buckets of money. And these buckets of money are things that you've saved over the years. And this may be, for example, an IRA. An IRA, anything that's pre-tax. We're not talking about a Roth yet. So that would be 401k that you saved in and you got the tax deduction. That would be a profit sharing plan, pension plan, SEP plan, cash balance, defined benefit, you name it, IRA contributions, it all goes into there. The point is money coming out that you're going to distribute out of this IRA is going to be taxable as ordinary income at some percent. And then you're also going to have a taxable account, for example. Now, this taxable bucket, you're going to get a 1099 on every year. So every year in this taxable account, you're not paying taxes on distributions per se. You're paying taxes on capital gains that are realized. You're paying taxes on dividends. You're paying taxes on interest income. But you're getting taxed every year, but not on the value of the account when you pull it out. So unlike the IRA, where you're taxed fully as ordinary income on the value of the account, on a taxable account, you're just getting taxed every year, no matter what, on those little bits and chunks and slivers of interest income and dividends and capital gains. And then finally, you're going to get this, hopefully, you're going to have some of this. The most advantaged, well, we're not going to cover the HSA. The health savings account is by far the best account if you can get it and if you qualify. But this we're going to do as a Roth IRA. But real quickly, HSA, the only triple tax-free savings account that there is. If you use it right, do the research or go on RetireWire and Google HSA. So you've got these three different types of accounts And this one, the Roth IRA, has no taxes forever. So for the rest of your life, you pay no taxes on the Roth IRA, on distributions, on distributions or withdrawals, on interest income, on dividends, on capital gains. It's tax-free forever. So that's your most advantageous account outside of the HSA that we're going to discuss. So we've got these different asset classes. We got these different investments, and they all have different tax implications. Where you put those within the context of the accounts that you have is a huge value add. Again, Vanguard says 0.75% if you're in the optimal scenario. Let's talk about the optimal scenario. The optimal scenario is if you're in a higher tax bracket, not a lower one, because if you're not paying much in taxes, this really doesn't matter as much. Now, granted, even most retirees this is going to have a huge impact on. So higher tax bracket, if your asset classes are diversified, if you're all into large cap value stocks, it doesn't matter because they're all going to just go wherever you can put them. But if you're diversified, you have a diversified portfolio, those are two of the major implications of whether you're an optimal scenario for this asset location strategy or not. But then let's go ahead and talk about, well, we know that asset location, there's all these ramifications of taxes and so forth and implications of where you put your assets, but where do you? So that's what I'm going to show you on the screen right now. What you're looking at right now is a chart of various index asset classes that are ranked from most tax efficient to least tax efficient. So you're going to see your most tax efficient investments be things like your international and emerging stocks and stock funds. Why is that? Because you're paying a foreign tax credit. It's not that they're super tax efficient. It's just that the taxes are already paid. So you're paying a foreign tax credit. They're very, very tax efficient. So where would you want to put those? Well, let's talk about the process. So I personally like to take and focus on, first things first, the Roth IRA. That is the most important tax advantaged account that you have. So what goes into the Roth IRA? Well, there's a decision point. And the decision point is, are you withdrawing these funds from the Roth IRA, or are you going to let them grow for 5, 10, 20 years down the road? And that's a very, very big decision point. If you are the former, meaning that, let's just say you've got a balanced portfolio and balanced accounts, but you're drawing up to your tax bracket from your we're going to cover this in a second here, the spending strategy. But you've got your streams of income, you've got your RMDs, you've got your distributions from your IRA up to a certain tax bracket, then you might need a little bit more. You would pull it out of the Roth. That's a different story. You don't necessarily want all of the volatility in the Roth. Let's assume for a minute that you are like most investors that are retired and you want to put off withdrawing from that Roth IRA as long as possible. Well, we prefer to put investments in the U.S. stock market into the Roth IRA first. That is number one. You can make the argument, well, I want international, I want emerging because they have a higher expected long-term return. It's not a bad argument. They're also substantially more volatile, and you've got things like foreign currency exchanges. It just so much more volatile. So we're going to have this home bias. We're going to say put all of our growth assets into the Roth IRA first. That is number one. Now, any growth assets left over, they're very tax efficient, right? So we want to look at international, emerging, international small value if you have that. Those are going to go into your taxable account. Why? And also anything left over from your U.S. allocation. Again, taking it back, the allocation is most important. That adds, in fact, Vanguard says the allocation, that's one of the 6 strategies I'm going to talk about at the end really quick. Vanguard says it adds up to 0.75 as well. So the allocation is most important. Develop your allocation first, make sure it works with your retirement plan, then use what you have as this low-hanging fruit to move them into different accounts. So you've got your U.S., your international stocks, they're very tax efficient. So we're going to put those into your taxable accounts that you're going to get 1099 on every year. And finally, we're going to look at anything that's left you would put into the IRA, obviously, because you have nowhere else to put it. But we're also going to look at things like your bonds and your bond investments, unless you're into municipal bonds, which aren't paying any tax at all, which would go into your taxable account. Your bond investments are best off in your IRA. There's another, it's like a double-edged sword, but it's a double-edged benefit. And if you think about it, the way that we're doing this, we're putting your more growthy assets into your best accounts and your lower growthy assets, or just the ones that pay interest like your bonds, into the IRA. Why? Because if you think about this over time, your IRA is going to be taxed at ordinary income. Why would we want to put these big growth assets in there? It doesn't make any sense just to pay more taxes later. We'd rather have our lower growth assets that are very, very important for your retirement plan to balance your portfolio, to balance your risk. But we'd rather put those into the IRA because it's going to grow at a slower rate, which means when you pull the money out, it'll be less in taxes. Finally, your alternatives, REITs, commodities, they vary. They run the gamut. Commodities can be incredibly tax efficient, which may go into your taxable account. REITs are not going to be so tax efficient, so those might go into the IRA. Or the Roth IRA, depending on how you do this. The whole point is you want to make sure that you're taking as much advantage of the tax code as possible within the confines of these different types of accounts. I didn't even talk about insurance yet. It's beyond the scope of this. It gets far more complex depending on the type of policy. We don't sell any insurance products at all. And we don't sell anything for commission. So it's just beyond the scope of this. And then additionally, you want to look at how are you managing your assets? Because within this whole concept, if you're managing them passively, everything's, or index based, everything's going to be on kind of a level playing field, very, very conservative from a tax and a turnover standpoint. If you're managing them actively, your financial advisors picking funds or buying and selling, ducking, dodging, trading, timing the market, you're going to have a much less tax efficient account, in which case, if you've got, for example, your stock funds, they may be best served in your Roth IRA, but if they're actively managed, you might find a place for them in your IRA. So there's a lot of variations to this. This is the general concept. The general concept, Vanguard says you can add about 0.75% to your investment returns over your retirement, and not necessarily your investment returns, but your overall returns, your financial benefit to your retirement, using an asset location strategy that takes advantage of the different asset classes you'll invest in and making sure that they're in the right types of accounts for you. One caveat as I pause. One caveat is be very, very careful where you're drawing your funds from, which accounts, how you're going to do it, because you don't necessarily want to be drawing funds from an account that's extremely volatile and international and emerging or commodities or things like that. You want to make sure that that account has some sort of stability with it, which is more a balanced or maybe a bond type of approach. Everybody's different. Everybody's unique. That's why you need a retirement plan. You need a really comprehensive retirement plan, not just a watered down sales pitch. All right, so let's go ahead and move on to Vanguard's strategy number 3, which is your retirement income spending process. Hey, so we made it to Vanguard strategy number 3, which is your retirement income spending withdrawal strategy, process, philosophy, approach, whatever you want to call it. It's how you're pulling your money out of your various accounts and living off of it. And Vanguard's puts a value of 1.1% on how you actually do this. So this is really, really powerful stuff. I saved the best for last. It's also, frankly, it's kind of the easiest. The rebalancing process is a little bit more complex, especially if you've got a really well-diversified portfolio with multiple types of accounts. The asset location process is a little bit more complex. And so this is actually the most value added according to Vanguard, and in my opinion, the easiest. So let's go ahead and dig right in. So first of all, you're going to have to live off of your assets and your investments and your streams of income in retirement to enjoy this wonderful retirement that you've already worked so hard to save for. And the very first thing that you cannot do anything about is your required minimum distributions if you are of age, which is going to be age 72 and a half, based under recent law. And so that's money that you have to pull out of your IRA, pay the taxes, and just be done with it. There's nothing else you can do about it. It's a rule. And so that amount of money is going to come out no matter what. That's going to be your very low-hanging fruit. That's what you have to spend first. Now, real quickly, we have so many clients make the mistake of saying, well, my RMD is, $20,000 and I don't need it all, so I have to spend it. No, if you only need $10,000, your RMD is 20, just put the other 10 into your investment account. Hopefully you've been practicing a lot of really aggressive Roth conversions up until the RMD age. That would put you in the best possible situation. That's what we do every day for our clients. We're very, very interested in making the most or minimizing their lifetime taxes. So Roth conversions are huge on our list. So the RMDs are number one. There's nothing you can do about it. Now, what's next? What's next is your taxable flows. And what I mean by this is maybe you have Social Security, maybe you've got a pension, you've probably got a taxable account that you get 1099 on each year with some interest income and some dividends and some capital gains. These are all things that there's nothing you can do about them. So you've got to spend those monies first. And so that's where you're at with your taxable flows being the next part of the process. And again, low-hanging fruit. After your taxable flows, Vanguard says that you should pull money out of your taxable account, meaning, again, the ones that you get 1099 on every year. And I think, again, if you've been very proactive in doing your Roth conversions, your taxable account should be very, very low, hopefully, because you've been using those to pay the taxes on your IRA to Roth IRA conversions. But I digress. So your taxable accounts would be next. According to the Vanguard study, I think we can probably do it a little bit better. But so if you've got your taxable accounts, you're getting your 1099s each year, you're going to use that to live off of next. And then what it comes down to is, well, you've got to pull some more money out, let's just say. Where do you pull that money out of? And if you think, for example, taxes will be higher, then that gives you one decision point. If taxes for you in the future will be higher, what you want to do right now is pull money out of the IRA, anything that is going to be taxable as ordinary income. Now, if you feel that taxes will be lower, that's a different story altogether. At that point in time, you want to take money out of the Roth, because why would you pay taxes pulling it out of the IRA now at a higher rate when you could defer that, take a little bit more out of the Roth now, and hopefully in the future you'll have a lower tax bracket. So that is really, in a nutshell, that's your retirement income spending strategy that adds 1.1% according to Vanguard. Again, this is also in the Morningstar study. They just kind of label it and explain it a little bit differently, and they didn't put individual percentage gains on each one. They just said, if you use all these 5 strategies, you're going to get up to 3%. So that's a little bit about your decision process on the retirement income spending strategy. Again, I think it's critical. It's absolutely critical. And the reason that we love to focus on this pre-retirement to early retiree age is because we've got these years from, let's just say, 55 to 72 now that we can get really, really efficient with Roth conversions, which are just going to slash your lifetime taxes. And that's the really fun part. When we go through a client's tax return and it's like, well, we got to convert this chunk of money over to over to Roth IRA, and it may cost us little to no tax now, and it's going to save us these big required minimum distributions in the future, which may thrust you into a higher tax bracket. So again, retirement income spending withdrawal strategy, 1.1% in value added. And now I'm going to dig into the additional 6 topics that we have not covered yet that are very, very important. But Vanguard and Morningstar, basically, it's not that they disagree on them. It's just that they don't have them in their reports. Okay, so remember how I said that Vanguard had 5 strategies in their report. You can add up to 3% to your retirement planning. Morningstar had 5 strategies. Vanguard had 7 strategies. They have various weights on them as well that you can add to your retirement planning. I covered the 3 that both Morningstar and Vanguard agreed on. Now, these additional 6 topics, they're in either the Vanguard or the Morningstar report, but they don't have them both together. Meaning that Vanguard doesn't have the same one that Morningstar does. So these are different and 6 additional. I'm short on time here, so I'm going to run through them. So first of all, asset allocation based on total wealth framework. So this is a Morningstar one, and that effectively says you need to look at your asset allocation, which Vanguard says you can add up to 0.75% to your retirement planning. You need to look at that based off of what streams of income do you have. Should those be counted as a bond if you use the present value of those streams over your retirement lifetime and so forth. So it's a more holistic look at your asset allocation. So that's asset allocation based off of a total wealth framework. It's highly complex, but it's a value added according to Morningstar. Testing your retirement income using annuities. Now, we don't sell annuities, but for those people who are retired or entering retirement, it is worth a look for you to consider, should I sell some of my investment portfolio and buy an annuity that'll give me a lifetime guaranteed income, or my spouse a lifetime guaranteed income after I die? And it's worth looking at. It's not necessarily right for everybody. In fact, we typically find it's not the best decision. But that being said, it is absolutely worth it. And the only way that you can do this is to look side by side. Here's my scenario. if I do the annuity, here's my scenario if I don't do an annuity, and here's different variations thereof. Maybe it's only a quarter of your assets go into an annuity. And again, we don't sell them. We don't do any work on commissions. We strictly work off of fees. But we do have some really good outlets for the best possible annuities that we can point you to with a phone call, and you're going to get a better deal than buying them through a really high price commission annuity salesman. So that's testing your retirement income results using annuities or not, and variations thereof. Liability relative portfolio optimization. I did a webinar on this as well. Asset liability matching. You can find that on RetireWire. But what the general concept is taking your next, let's just say 6, 7, 9, 10 years worth of expenses. You know what you're going to spend these years. Some years will be higher or lower based off of a trip or a car purchase. You're going to have inflation growth, and you set those years of expenses aside into a very safe, conservative asset like a bond. Or a mutual fund that's maybe going to mature, like an ETF or something, at those specific points in time. So that would be your liability relative portfolio optimization. This is another strategy that we use. We also do something a little bit different with our clients, but Morningstar is big on that. Low cost portfolio implementation. I am betting that the average investor, actually, you can just do the research. You'll see that I'm right. The average investor out there with their mutual funds is paying probably 3/4 of a point and almost 1%. Some of them are paying more than 1% for their mutual funds for their investment planning. And so this is basically saying you can save, the Vanguard actually puts a value of 0.40% on this. The average passive portfolio or index fund portfolio is probably closer to 1/4 of a point, maybe 1/3 of a point. So you can save a lot of money by using a low-cost implementation strategy. It's far beyond the scope of this to get into why this makes the most sense, but it really does. Trust me, it really, really does. Behavioral coaching. I know you're thinking, yeah, that's not me, Greg. I'm not the guy who sells at the bottom. I'm not the person who's going to freak out and make the wrong decision at the wrong time. But the truth is, most people do. We've got people that we've worked with for well over a decade, going on, actually getting closer to 2 decades, that they still are very, very prone to making the wrong decision at the wrong time. And Vanguard places a value on that of about 1%. So it's just something to consider, but a really, really good behavioral coach who can, and frankly, you can't do this without a retirement plan. If you don't have a really comprehensive retirement plan, you don't have anything to fall back on and say, well, where am I at now with my plan? Did my Monte Carlo, which is a term that we use to measure the retirement plan results, did it go up? Did it go down? Where am I at? Do I need to make a change? Should I get more aggressive in a bad market? So unless you have a full comprehensive plan, this is kind of a very gray box type of thing. It's really easy to say that you won't make a bad decision. Most people do. Behavioral coaching adds about a point. Total return investing versus chasing yield. We get so many retirees who say, well, this preferred stock's paying 7% and I need the income. And it's just not the way you want to do it. Most people pay higher taxes on the income than they do on the capital gains. What you really need is a diversified portfolio that matches your retirement plan from a standpoint or a perspective of your risk tolerance, your risk capacity, your risk required, and forget about whether it's your income is coming in the form of a dividend or an interest payment versus a capital gain. As long as you get the income. So it doesn't really matter where it comes from. Vanguard places a very, very high value on that as well. Those are the additional 6 strategies that I told you. I had to blow through them because I know we're running short on time. But those are the additional 6 strategies. I'm going to send those to you in the reports, as I mentioned, as I promised, as well as the other bonuses and the cheat sheets here in just a few minutes. But for right now, what I'm going to do is just kind of wrap everything up for you, and then we're going to send that out. So we made it. Did I do it? Did I fulfill my promise to you? Did I show you how to add $250,000 to your retirement plan without taking any additional risk? So we got the portfolio rebalancing. No additional risk there. In fact, that's actually a risk-reducing strategy. You'll have less risk. And we showed you the asset location, which no additional risk there. You're taking the same investment portfolio allocation, just being more smart about it from a tax standpoint. And then we talked about your retirement income withdrawal spending strategy, philosophy, practices. No additional risk there, just a better approach to withdrawing your retirement income. And we also touched on Roth conversions, which frankly are huge value added, probably more than all 3 combined. But anyways, Did I accomplish my goal? That's my question to you. Shoot me an email. Let me know. I'd really love to hear your thoughts, your comments. But really, what I wanted to talk about is what if? What if you were playing the private course instead of the Muni? I mean, would that $250,000 help you get there? What if you were driving the Tesla instead of the pickup truck? Would that be a better retirement lifestyle? Or maybe it's travel. Maybe you'd like to fly first class instead of coach. And so there's all of these different ways that you can use these assets and these strategies to add value to your bottom line. And, even if it's just leaving a legacy or to a charity, even if it's a larger legacy, what if you could do all these things and you could do them yourself, or you could do them with your financial advisor and you could add that $250,000? Or best yet, what if you're in the optimal scenario? If you're in the optimal scenario and you can add closer to $600,000, how would that change your life? So those are the questions that I have for you. And, before I get into what I'm going to propose real quickly, if you'll allow me, I guess I just have to say thank you so much for sticking around to the end. You're definitely going to get these reports. You're going to get all the resources. You're going to get all the links. You're going to get that cheat sheet and the bonus and so forth as far as the asset location. But what I want to talk about now is what we can do together for you to get these things incorporated into your plan at a very, very low risk, low entry point approach. Okay, so here's the deal. You've got the 3 strategies, then you got the additional 6 strategies. Go ahead and ask your financial advisor. Are they doing this for you? If they are, you should know. You should be giving them. They should be asking for your tax returns. They should be incorporating this into your plan, and they should be reviewing these strategies with you. My gut tells me no. There's probably about a 90% chance that your financial advisor is not doing this for you, and there's about a 90% chance that you're not doing this on your own as well if you're a DIY type of person. And so, if you'll allow me, I got a quick offer to make you. We've got 3 types of clients that we work with. We've got our private clients that we work with that we do everything for, from the full planning to the implementation to the tax management to the Roth conversions to the asset location to all kinds of things such as homesteading your house and so forth. So we do all kinds of things for our private clients, and they pay us a minimum of $4,000 up to about $20,000 per year. That's our private clients. I'm not saying that you should become a private client of ours. I don't know that that's right for you, and it's not right for everybody. In fact, the fastest growing segment of our client base is actually what we call our Zoomer clients. Now, these Zoomer clients, we do a full comprehensive financial plan. It's like a planning event, which takes about 3 hours with one of our certified financial planners to execute. You're going to get an executive summary, and you're going to have all of this information and a really great roadmap for the future mapped out for you, laid out for you, and you're going to get that. Then you're going to go implement that on your own. We charge for that $2,000, and we do a lot of Zoomers, but we also have finally our hourly clients. Now, our hourly clients, we will sit down and answer any questions that you want. Typically, people will bring us a list of things, and we charge $350 an hour for that. And so what I would like to offer you, if you are interested in implementing these strategies for yourself, whether you want to do it as a DIY type of thing, so you're going to implement them on your own, or you're going to have your financial advisor do it, start with an hourly consultation. In fact, I'll go one better. If within the first 15 minutes, if you don't think that you're going to get the value out of this that you expect, then we'll part ways with a handshake. Or if we're doing this through video conferencing, we're doing more and more video conferencing meetings with clients, then we'll just say goodbye. We're not going to charge you. So give us a test drive for free. You're literally talking about a free test drive. Show up on the call, schedule an hourly consultation. After this, you're going to get an email with all the reports that I mentioned, and it's going to have a big button that says Get Started. All you have to do is click that button, fill out a couple of questions. We'll reach out to you, or you can schedule us directly. Yeah, you're actually going to be taken to a booking page where you can schedule us directly for your hourly consultation. And again, if after a few minutes, if you decide, yeah, it's not right for me, I'm not getting the right answers, I don't like your bald head or your red beard or one of the other planners, I don't like their necktie for the day, that's fine. No problem. You can try us out for free. So there's no cost. There's no cost. And I'm going to even go one step further. Let's just say that you try us out for an hour, and you spend this $350, and you think to yourself, wow, I learned how to allocate my assets in a tax-efficient fashion. Let's just say that was your main question. That was number 2. Or let's just say, yeah, I wanted to discuss my spending strategy with these accounts that I have. And that was number 3. The third strategy went over. Or even if it's the rebalancing. And hey, how do I rebalance this jumbled mess of investments that I have? Or anything else from your 401k to other IRAs to how can you can save more tax efficiently or decumulate, or Social Security questions. We do a lot of Social Security consultations. Let's say you get through that hour and you decide, yeah, that was good, but I've got way more to learn. Then what we're going to do is we're going to take this $350 and we're going to credit it towards a $2,000 financial planning engagement fee. So you're not going to lose that $350. We're going to actually reduce the cost of your full Zoomer plan by that $350. And that's going to give you a beautiful roadmap for your retirement future, not just a watered down sales pitch, because we're not selling anything. We're not managing anything. We don't work on commission. We work on fees. And then finally, the last offer that I'll make is, let's just say that you do that Zoomer plan. You've now test drove us and you know who we are and what our certified financial planners here in the office can do for you. And let's just say that Zoomer plan that we do for you, you love it. And this is what happens a lot. In fact, real quick story. We have so many clients who do a plan and then 3, 5, 10 months later, they call us and say, I didn't do anything you told me to do. I just left it sit there on my computer and I just need you to do it. And that happens constantly. And so let's just say that happens to you and you want us to actually take the reins and manage it for you. We're going to take that $2,000 and we're going to credit it to whatever your private client fee would be. And so you're not going to lose anything by taking these small commitments to see what we can do for you, how much value we can add for you. In fact, we're going to credit everything from, again, 15 minutes for free. If you don't feel like you're going to get the value out of the hourly, that's fine. We'll part ways. We're not going to bill you. But if you do the hourly and then you say, hey, I need a little bit more help, let's go up to a plan, or I need another hour, that's fine too. And then you do the plan, the Zoomer, and you say, I need more help. That's fine. We're going to move you into our private client elite category, and we're going to do everything for you. Not only we're going to do everything for you, but we're going to give you a client services calendar that's going to show you every aspect of what we do and when we're going to do it. And we're going to give you a client report card that grades us and our performance on what we provide you. Do other advisors do this? Because I've never heard of this before. It was actually kind of my brainchild. I thought, well, shoot, my kids are going to school and they get graded. Why aren't we grading ourselves for our clients? Why aren't we showing them, hey, here's how many times we did financial planning. Here's how many times we did tax planning. Here's when we reviewed your insurance needs and possibilities. Here's when we looked at your investment and rebalancing. Why aren't we grading ourselves? It just makes sense, right? So we're going to actually grade ourselves against this client services calendar as a private client. But I'm getting ahead of myself. Don't start there. Start with an hourly. If you want help with any of these 3 strategies, pick one, pick all 3, and we'll do our best. Honestly, depending on your portfolio, it may be a little hard to accomplish in an hour. We'll do our best, though, and we're very, very efficient. Start with an hourly. Start with a $350 commitment. Use the first 15 minutes for free to make sure it's a good fit and that you got a good warm and fuzzy with us. And then let's see if you need more. And if you don't, great. We're going to be here in a year when you want to do another hourly. We're going to be here in 5 years when you actually need a plan. We're going to be here in 10 years when you say, hey, this is overwhelming. I need you to take the reins and help me out because I want to play the private course. I want to fly first class. I want to leave a legacy for my alma mater, for my kids or my grandkids. We're going to be there for you. So to do this, to implement these 3 strategies, you need 3 things, ironically enough. And we're not even talking about the other 6 things that we touched on so briefly. You need the time. A lot of you have the time, especially being retired or close to retirement. You need the desire. A lot of you want to do this, and that's great. It's a lot, well, it's a lot of fun to some people, not to most of our clients. And you need the knowledge, the experience, credentials, that type of thing. And that's where most people fall flat. And they think it's easy. And again, I tell you, most people think they're doing all these things, and they're not. Most people think their financial advisors doing these things, and they're not. And so, again, that's why I made you the offer. Get started, 15 minutes for free. If we're the right fit and you feel good about it, we're going to dig right in. We're going to roll up our sleeves. Just an hourly consultation where we can help you learn asset location, help you learn portfolio rebalancing, and tell you with your portfolio how to do it. Maybe even give you an asset allocation or answer questions about your 401k or whether you should roll it over or not, or Social Security. Anything that you want to tackle in that hour, we're going to do. And then if that makes sense for you and you want more, then we're going to credit that to your plan. And if that makes sense and you want more, we're going to credit that planning fee into your private client fee. So if you don't have all 3 things, the time, the knowledge, and the desire to do this, reach out to us. We're here to help. You will work with only a certified financial planner who is a fee only. We don't sell products for commissions. Fiduciary, meaning your interests come first above ours, above everything else. Go ahead and visit redrockwealth.com. Click Start Here. Or if you wait, you're going to get an email with all the reports I mentioned and the bonuses and the little cheat sheet with the tax efficiency. Or go ahead and click Get Started Here from that email, and we're here to help you when you're ready for us to help add that $250,000 to your retirement. Thank you so much for your time. I really appreciate it. I know time is a valuable commodity that you cannot get back, and it means the world to me. Have a wonderful rest of your day.